And there they come.
Good morning, everyone. Welcome. We'll give you a moment to get in.
I always wondered, is it that the participant count, is it accurate as of the second it shows the number change? Like, why does it take, a second to add each participant onto the show? It's quite interesting.
Well, and it's also interesting because like the number of people who registered is way higher than what we ever get here. So but Kevin did an experiment one time. He was polling people to see how they watch the show, and like a third did it live, a third called in, and a third would watch it on a recording later. So I don't know if that still stands, but good morning, everyone. Very happy you're here. Thank you for joining us. We are very, very happy, Kevin, Casey, and I, to have Dan Habib with MBS Highway with us this morning. Welcome, Dan.
Hey, thanks so much for having me, guys.
Oh my God. I was just telling Dan how well he has grown up. He is just a wonderful human, and he's smart, and he's got a lot of information to share. So we're really excited to speak with you today. And I was mentioning that a few of us are working through our way through the CMA course, the Certified Mortgage Advisor course, and really enjoying it. Really, it's full of good information. And it's interesting for those of us who listen to the update every morning. We hear all these things, but we don't necessarily have it internalized, and this is helping with that. And so anyway, I was telling Dan that I watched his section last night. It was really well done. So with that, Dan, we're going to start this morning. You have a presentation for us, and we're going to start there, and then we'll move into some questions and conversation. All right. So take it away.
That sounds perfect. Well, first of all, it's an honor to be here with you guys. And, is there enough excitement out there in the markets for you? We know that there's a lot of moving parts right now. We have
moving is a key word.
Yeah, 8.6% inflation as measured by the Consumer Price Index, highest in 41 years. And listen, you guys are all feeling this, right? Whether it's home prices, which are much higher, but go to the gas station, food, you name it. And we also have the Fed, who is now aggressively changing their position and trying to curb this inflation by using some of their tools out there, reducing their balance sheet, hiking the Fed funds rate. We want to break some of this stuff down methodically because there's a lot of misinformation out there. People think that the Fed is hiking mortgage rates. We're going to break some of that stuff down. There's also now a lot of talk of a potential recession. And we know the media is out there beating the drum on a housing bubble, as they have for about the last 9 years. So want to take you through all these things, hopefully make it easy to understand, and give you some great ammunition when you're talking with your customers and referral sources out there. So I'm going to share my screen here, and we'll jump right into it. And it looks like I need the ability to share the screen, Audrey.
Oh, good God. All right. Hang on, please. How do I do that, Kevin? It's a first.
There should be like a little shield there you can
shield.
It looks like a shield, and you can enable sharing.
Okay, a shield.
On the bottom there, next
Yeah,
to participants.
should say share
screen
button.
Share screen? Oh my God.
Yeah, but then you click next to that, and then you allow others to share screen.
Oh.
I'm doing this from my iPhone, otherwise I'd be able to help
Sorry.
you.
So Kevin, you're in Ireland right now. Why don't you tell people about your little
While you're doing that, I can
thing? Just take a moment while I figure this out.
I've lost my camera. Let me go back. So yeah, I am in County Cork at the moment on the west coast of southern part of Ireland, in the Republic of Ireland, and on a nice little vacation. Next week I'll be reporting here from London, so it's going to be quite the adventure of rushing around trying to find Wi-Fi and report in, but it's still kind of fun. And it's 7:00 in the evening here for me. So
yeah, well, good. I'm glad you're able to get it together. All right, Dan, how did that?
I now have the ability to share. Thank you very much.
God, I'm getting so good at this. Holy smokes.
So first off, I just want to start with something that's a little bit optimistic, right? Meaning this, I know that you guys are having challenges out there, right? We know refinances are down about 77% year over year, but the purchase market is still strong. And listen, if you look at applications, yes, they're down around 10% year over year. But if you take a look at volume, of course, compared to the last 2 years where we saw over 4 trillion each year, we're seeing a big decline from there. But the estimate, and even if it's a little bit high, but the estimate out there right now is 2.6 trillion, most of which is purchase business. If you just take a look and you kind of zoom out a little bit, it's still the third best year in the last 16 years. So there's still a lot of challenges out there, but there's also, when there's challenges, opportunity. And I think that if you really understand what's happening in the market and you're really an advisor to your customers and referral sources, you can gain market share and overcome some of these obstacles and challenges. So first off, we were talking about inflation, right? Inflation is the biggest problem that not only the US has, but really it's a global economy issue out there. And we've seen this thing now get to yeah, exactly. We've seen this thing now get to a 41-year high. So inflation is the main driver of mortgage rates. A lot of people out there think that mortgage rates are rising because the Fed is hiking rates, but I'm going to explain to you that it's actually the opposite in a counterintuitive way. So why is inflation the biggest driver of mortgage rates? Well, first off, let's start with what inflation is. The definition is too many dollars chasing too few goods. So we know that we kind of have a perfect storm of inflation right now because COVID crippled supply chains. They are still on the supply side, not back to where they were online to that degree. And then on demand side, well, where'd the too many dollars come from? Well, you had a combination, in my opinion, of bad fiscal and monetary policy. We know that we had trillions of dollars of stimulus. And then on the monetary policy side, the Fed was way too accommodative for too long. So the Fed has a couple tools. Number one is they kept the Fed funds rate at 0 for an extended period. Many criticize that they should have been hiking sooner as inflation was getting out of control. The other thing they did is they injected all kinds of liquidity. They amassed a balance sheet of $9 trillion, and they did that through buying mortgage-backed securities and treasuries. And at one point, they were buying $120 billion a month for a while. And that's how they got up to this $9 trillion balance sheet that they have. So bad fiscal, bad monetary policy causing inflation. They didn't react. They made the mistake that they thought it was transitory. And you guys are all feeling this inflation. So what is the Fed going to do about it now? Well, the Fed is starting to tighten monetary policy. And what they're doing is they are hiking the Fed funds rate. So what is the Fed funds rate? It is not a 30-year rate like a mortgage rate. Instead, it's an overnight rate that banks lend to one another. So this does have a direct impact on certain things. So your short-term treasuries, your car loans, your credit cards, your small business loans. And that's really the big one, right? Because when the Fed funds rate's at 0, very cheap for small businesses to expand and increase their operations and such. But when you have that now heading where the Fed wants to take it towards 3.5%, that makes things much more expensive for them, makes them second guess things like expansion. And remember, our economy is very much a credit economy. So people think about cash, and yes, the M2 money supply out there has increased about 40% over the last 2 years, but credit for every $1 of cash is about $17 worth of credit. So the Fed is literally trying to slow down the economy in order to curb inflation. And by making the cost of certain things higher, borrowing more expensive, then of course that's going to eventually slow down the economy. But how does it impact mortgage rates? Well, mortgage rates are most closely tied to inflation. And remember, the reason for this is because mortgage rates are a long-term bond, right? So theoretically 30 years. And inflation, what it does is it erodes the value of a bond's fixed return. So let's just give you an example here. If I said, Kevin, can I borrow $100,000? Kevin might say to me, okay, Dan, I'll lend you $100,000, but not for free. I'm going to charge you a certain interest rate. Right. So let's just say that interest rate, it nets him $1,000 a month in interest that he has fixed. We have a contract for 30 years. So maybe the first few months, he has a list of goods. He goes to the store, he could buy everything on that list. Well, all of a sudden, as inflation is rising in the background of the economy like it is today, Kevin realizes, you know what? Now I can only buy 3/4 of the stuff. Why is that? Well, the cost of goods and services has gone up while that return has remained fixed. So inflation literally erodes the buying power of a fixed return. And it's especially impactful on a long dated maturity bond like a mortgage. So Kevin can't do anything about the loan he gave me. But what if Audrey then says, hey, Kevin, can I borrow $100,000? He might say, okay, but what is he going to do? He's going to charge a higher rate of interest. So he starts at a higher perch, meaning his return is higher, and that will combat the faster pace of erosion due to inflation. Now, this is an oversimplified example, but it doesn't work very dissimilarly with investors, right? Because there's always an investor on the side of this that's buying these mortgage bonds. And if inflation's rising, well, they're going to demand a higher rate of interest. So that's why, and you can see on this chart, inflation here is the white line, and the blue line here is 30-year fixed rate mortgages. And you could see how these things mirror each other. Oftentimes it's inflation that kind of leads the way, and then you could see mortgage rates keep up, and you could see how closely tied they are to one another. So the Fed is now hiking the Fed funds rate, but because what they're trying to do is curb inflation, if they're able to get inflation under control, believe it or not, and counterintuitively, you can actually see mortgage rates come down. Now, we've seen this many times throughout history. If you go back to the 70s with Paul Volcker, he hiked the Fed funds rate 9% in the matter of like 6 months, and we saw mortgage rates come down by 6%. If you look in the 90s, Alan Greenspan, he hiked the Fed funds rate by 1.75%, and we saw mortgage rates come down by 3%. So if the Fed is successful in getting inflation under control, we actually should see mortgage rates start to come down because inflation is the main driver of mortgage rates. Now, the big question out there is this, when are we going to see inflation really start to turn around, right? So last month, we just saw it hit a 41-year high at 8.6% year over year. Well, if you figure out how these reports work, you can get do a little bit of a better job forecasting where things are going to go. So if we take a look, this report is a 12-month rolling report, which means that if you take a look at the previous 12 months, you add up all those monthly inflation readings, you get your year over year 8.6 inflation number. So what does that mean? Well, next month, which is going to be the month of July, we are going to get the new 2022 reading for June. So what that means is it's going to be replacing the June number from 2021. Well, if you take a look at the number we're replacing, it's pretty high bar at 0.9%. So if we see a number below this, you actually might see the inflation number come down from 8.6%. Now, if it's above it, it might go up. But a lot of people saying that, hey, maybe we've reached peak inflation. My thing is that I look at is they're not looking far enough down the chessboard, because if you look at the summer months from last year, what do you see? Some pretty small numbers, 0.5%, 0.3%, 0.4%. So you could very well see maybe inflation stall or come down a little next month. But then over the summer months, I think you could see a little bit of a resurgence. But I could tell you when I think inflation is definitely going to start to come down, and that's by the fourth quarter of this year. You can see the comparisons from last year get much tougher on a consistent basis, but also the Fed's rate hikes will start to take hold. A lot of people hear the Fed's hiking and they're wondering, well, is this priced into the market? It could be attempted to be priced into the stock market or the bond market, things like that, but it's not truly felt by the economy for a little bit of time. Much like if I was sick and I went to my doctor and they prescribed me some medication, 5 minutes later, I'm not going to be dancing on the tables here, right? It's going to take a few days for it to impact my immune system. It's no different here with the Fed rate hikes. So I believe by the fourth quarter, you'll start to see inflation come down because on a comparative basis, the comparisons are much higher from last year, but also because the Fed rate hikes will really start to slow the economy down. I fully expect them. They just hiked 75 basis points in June. I think they're going to hike another 75 in July, and then we'll see what happens in September, maybe another 50 basis points or so, depending on the data coming out. So the big question is we're already seeing signs of the economy slowing. And Audrey, you brought this up. We saw negative Q1 GDP, but not just that. If you take a look at the estimates for Q2, a lot of companies out there, like the Atlanta Fed, they try to do estimates for where they think the number is going to come out. A lot of estimates out there showing a goose egg or a 0 for Q2. The reason why people are looking at this is because one of the textbook definitions by the NBER of a recession is 2 consecutive quarters of negative GDP. Now, they've expanded that definition to include some other things now, but even if we don't get a recession by, let's say, next quarter, I do think that we are certainly headed for a recession. I'm going to show you why. So this is nothing new from the Fed. The Fed oftentimes, and I'm going to be a little critical of them here, though, but listen, the Fed is a group of academics where not many of them have a lot of real world business experience. And in my opinion, they're very much so responsible for these boom and bust cycles that we see. They're way too accommodative for too long. They wait too long for that, and then they start hiking, and then they're too tight for too long. And this creates these boom and bust cycles that we see. And if you take a look at this chart, this is the Fed funds rate, and these blue vertical lines are your recessionary periods. Well, you can see what happens here, right? And you can see it almost in every instance here. You can see the Fed hikes to curb inflation. We get a recession, and then they have to reverse course and start cutting. And you can see that happen time and time and time again. And now here they are on one of the most aggressive rate hike cycles that we've seen in a very, very, very long time. So I do think that the Fed will push us into a recession. Now, there's some indicators out there that I'm tracking that are very reliable that would also agree with this. So one of which is called the inverted yield curve. Now, you might have heard this in the media, but I'm going to explain to you what it is. So a normal yield curve is up and to the right. What that means is if you were going to invest your money in a 2-year treasury note versus a 10-year treasury note, well, you would expect to get a higher rate of return for putting your money away for a longer period of time. So the yield curve would go like this. 10 years, I get a higher rate of return than 2 years. But there's these phenomenons, or there's these periods of time throughout history where the 2-year yield is higher than the 10-year yield. Now, that sounds backwards or upside down or inverted. And we actually just saw this April 1st, and we just saw this a few weeks ago as well, where you're starting to see these inversions occur. Now, why is this a big deal? Well, it's a symptom or a sign of weakness in the economy, and it's been a very reliable recession indicator in the past. So if you take a look, when this yield curve goes inverted on this chart, it turns red. Well, you can see here, inversion, recession, and you could see that happen time and time and time again. It even happened here before that 2020 recession we had due to COVID. So we've seen a few inversions now. I think we'll probably see some more meaningful ones as time goes on as well. But this is one indicator I'm looking at for a recession. Now, another one that's a big one is the unemployment rate. Now, conceptually speaking, you might think to yourself, we probably get a recession when the unemployment rate's at its highest point, but it's actually quite the opposite. So take a look at this chart. You can see the unemployment rate is this white line. And again, your recessions are these blue vertical lines. Well, every cycle, every market cycle that we see, the recession occurs when the unemployment rate hits the low in the cycle and then begins to turn higher, that you get a recession, and then you see the unemployment rate really shoot up. And you could see that time and time and time again. It was no different in the last recession where we saw unemployment at 3.5%. And then you could see this started to go a little vertical. Now it went all the way up to 15%. We had some crazy circumstances there with COVID and such and shutdowns, but right now we're at 3.6%. In my opinion, I think that is the low of the cycle. And you guys see this stuff anecdotally, right? You see all these companies out there laying off 20% of their workforce. So why does this occur? Well, when the economy is good, companies are hiring, employment's tight. But then when things slow down, what happens? Well, one of the first things companies have to do is they have to reduce headcount. Now, once they reduce that headcount, those individuals, those poor people that were just laid off, what are they going to do? Well, they're going to change their spending habits. They're not going to go out to the movies. They're not going to go out to those restaurants, to the retail stores like they were, right? They're going to have to tighten up. And all those businesses that were relying on that money, they're going to slow down. They're going to have to lay people off. And it's really like a snowball effect. And from what I'm seeing in the headlines, we're starting to see a lot of companies start to trim workforce. We haven't seen it show up in the numbers yet, but I can tell you the first place that it's going to show up is in something that we get every Thursday called initial jobless claims. Now, the 4-week moving average of that has been moving up. It's at some of the highest levels since January, but we haven't seen some really big increases. But I think over the next month or so, you're going to start to see it show up there. And what this report measures is people filing for unemployment benefits for the first time, meaning they just got laid off and now they're filing for their unemployment benefits. Once that starts to occur, guess where it shows up next? The unemployment rate. So I think we'll start to see the unemployment rate move higher from 3.6% where it is now. And I think that'll be another sign for us that we're headed for a recession. Now, I also took a look at both inflation and the unemployment rate, and I looked historically. So the interesting thing that I found is this. Throughout history, when you have inflation above 5% and the unemployment rate below 4% on average for a quarter, and by the way, the first time we saw that was Q1 of 2022, at least historically, there's a 100% chance of a recession over the next 12 months. So that's why part of the reason why I believe by Q1 of 2023, we will be in recession-like conditions.
Okay, so hang on 1 second.
Yeah.
Just have to jump in here. First of
Go
all,
ahead.
there's two things that are really important. And the first one is that if Kevin ever charges me more interest than you, I will punch him in the face. The second thing is Kevin actually has been talking about this whole idea that, inflation can't be higher than the rates, et cetera, et cetera, et cetera. So I just want to give him credit for that because he started talking about that. And at first I didn't have a clue what he was talking about, but he got it right. So good one, Kevin.
Yeah. When you go look back at this chart, you see that right now inflation is higher than mortgage rates. And that just doesn't happen very often.
And, if you are of the belief, and I think I just laid out some reasons why you should think that we're headed for a recession, right? Remember, the economy is starting to slow and the Fed is purposely slowing it down. The big question is this. Well, what does that mean for mortgage rates? What does that mean for real estate? Is now still a good time to buy a home? So what I want to show you next is that remember that inflation is the biggest driver of mortgage rates. Well, I told you that I think by Q4, we'll start to see inflation come down. You'll start to see a little relief in mortgage rates. But by Q1 of next year, I do think we'll be in a recession. And when you see recessions, they are deflationary by definition. And if you look historically at what happens with mortgage rates during recessions, well, in the last recession, they dropped 1%, 3.75 to 2.75. Recession before that, 6% to 4 7/8. Before that, 7 3/8 to 6 3/4. Before that, 11 8 3/4. Before that, 18 to 13. And before that, from 16 to 11 3/4. So I think you can see the pattern here that during recessions, interest rates come down. So if you believe this, and if we now know this, how should you be positioning your business? Well, first of all, I would be thinking to myself that, hey, when I talk to customers, we want to talk about not just their transaction today, but how does the transaction today fit with the refinance we're going to be doing in the future? Now, there's a couple things on this that make it complicated. Where possible, I would be doing as little cost loans as you can, because listen, if you're doing upfront MI, if you're paying points, if you're doing high fees, all these things are going to have break evens, maybe 3 to 5 years. And you're going to have an opportunity to refinance this individual most likely over the next 12 months. Probably sounds a lot different than what some of your competitors are saying. Now, listen, I know it's hard to get a 0-point rate out there. And the interesting thing is the reason why it is because they agree with what I'm telling you. And what I mean by that is, when you're selling a loan out there in the secondary markets, maybe they're selling at 102, 103. So there's enough margin there, right? So that investor that's paying the premium for the loan, they don't get all their money back right away. How do they get their money back? With the yield, right? With the interest rate that they get. Maybe it takes a few years for them to start really making money on the loan. But what happens if there's a big prepayment risk? Meaning these investors out there, they're thinking that rates are going to come down too. So they're making it very painful for you to get a 0-point rate because of that prepayment risk that's out there right now. So that's kind of some of the dynamics, but in a weird way, it kind of shows that, hey, they too think that interest rates are going to be coming down as well. Now, how about real estate?
Okay,
Well,
hang on. Let's just stop there for 1 second because I have a question about that. So if you, going back to that chart, it shows that the average decrease in rate was like 1 to 1 and maybe a quarter, except for, the aberration of 5% from 18 to 13%. But so if that is the case, and we're in the 6s right now, does that mean that we are going to be looking at a drop in interest rates into the high 4s in the 5s? Because first of all, we had, people, some of the Fed members saying they don't think we're going into recession, which of course I don't agree with, you don't agree with, but also they were, like I also heard somebody saying, oh, we're going to be at 1.5%. Like what? How is that?
Yeah.
So
they were
how
talking
do we
about the
reconcile
10-year.
all these mixed messages?
Yeah, great question, by the way, Audrey. So listen, there's a lot that depends, meaning it's hard to say how much rates are going to drop and exactly when. A lot of it depends on the depths, the length, and the amount of this recession that we're going to see, right? And how much the economy slows and what actions the Fed take to get us out of the recession, right? Are they going to start cutting and then reinvesting instead of reducing their balance sheet, right? We'll have to see how that plays out. But, to put some rough numbers on it, and don't hold me to this, I could see rates right now, which are maybe a little bit over 6%. I could see by the end of the year, maybe them coming down to in the 5s somewhere. And then maybe by the Q1 of next year, maybe having a 4 handle on it. I don't think they're going to get back towards the lows of, 2.5 or something like that.
We may never see those again.
Say that again.
We may never see those again.
Yeah, I mean, listen, it's tough to say, but never say
those
never, right? But yeah.
But
We just want to make sure we're keeping the
precedent in
expectations
that.
realistic as people are hearing so many different, pieces of others' opinions. And just, we've had a couple of people ask whether they'll be able to get the recording. And typically we are posting it on our website and we are sending it out. We've been out of that mode for the last 2 weeks, but we're about to get back into it. So you should be able to get a recording of this presentation when we're done. Okay, so there you go, Dan, keep going.
You got it. So
Good
what
stuff.
about real estate, right? Because, people hear about potentially going into a recession, and we were one of the first ones to talk about it, but now it seems like everybody in the media is agreeing with us. What does that mean for real estate, right? So here's the thing. A lot of people, when they hear recession, they remember the housing bubble, and they remember the pain that caused. They remember a decrease in home prices. And what the mistake a lot of people make is this, is that they mistakenly believe that the recession caused the housing bubble. In fact, if you look back to here, the housing bubble really led us into a recession. Now, there was also a lot of different things happening back then, right? So back then it was kind of like fog up a mirror and maybe some irresponsible loans being done, right? 580 FICO, no income, no assets. Let me give you 4 homes and a condo like the go-go dancer in The Big Short, right? So we know now things are much, much different, much stricter underwriting guidelines. Loan performance is fantastic. People have record levels of equity in their home. So it's a completely different market from a health standpoint. But how about from a supply and demand standpoint? Well, we're going to go through that with you. But in short, there was a glut of supply, not enough demand to sop it up back in 2007. Today, we're seeing the opposite, even with the rise in home prices and rates. And I'm going to show it to you with data. But the other point I want to make on this chart is this, is that if you remove this, take a look at every other recession. And by the way, this white line shows you home prices as measured by Case-Shiller. And if you take a look, during these other recessions, home prices, in fact, did quite well and even increased after the recession. And you can see almost every single one of these, what home prices did during these recessionary periods, or they at least remained pretty stable. So want to now break down for you what some of these numbers look like. And by the way, Case-Shiller, they just released this morning their new home price index. It is lagging by 2 months. So it was for the month of April, but they reported 2.1% appreciation in the month of April alone. So certainly not seeing, a big decline or anything like that, right? In fact, you're seeing an acceleration even with, and this doesn't kind of take into account the full rise in rates that we saw, right? But you're not seeing any slowdown as of yet within these reports that are looking back 2 months. But what about the media out there, right? So the media is not your friend. The media is smart. They try to appeal to the amygdala, the part of your brain that registers fear. And, you don't turn on the 10 o'clock news and it's like, everything's great. It's like, here's the 10 things that can kill your kid. Let's get your eyeballs on this, right? So we like to pick on Diana Olick a little bit because she's been negative on housing for the last 9 years, literally calling for a bubble every single year. And I want to show you some of the headlines that I pulled. So October 2015, a housing bubble today larger than 2006. And I went and I did the honor here of showing you what that would mean if you listened to the media and you didn't buy that $300,000 home. Well, you would have missed out on 5.1% appreciation or roughly $15,000. 2016, we're in a new housing bubble. Really? Well, we saw 5.4% appreciation or $17,000 that year. 2017, home ownership doesn't build wealth, a study finds. Well, I think anybody that bought a home then and they're still holding it now would certainly have a big argument with that. We saw 6.1% appreciation or $20,000.
What study was that? Holy smokes.
They have, I don't know the exact source. These are the headlines from CNBC, but at the time I had gone through it. It might've been something from Adam Data Solutions. One of these.
Oh, yeah, they're really reliable.
Very negative. Listen, statistics is a funny thing where, you can bend it any way you want, essentially, right? I mean, one of the faux pas I have with Adam Data Solutions is like, I see them now saying, foreclosures are up 100-something%, right? But they forget to tell you that it's from zero because you had the moratoriums. But if you compare it to what foreclosures were before COVID, it's down 75%, right?
Right.
So
We've talked about that a lot. Like, don't look at the headlines in comparisons to last year or the year before. You've got to go back to 2019, 2018 to see what realistic normal-ish looks like to do a proper comparison. So we've been beating that drum for quite a while. But I find these headlines crazy. Keep going.
They are crazy. So September 2018, it's better to rent than buy in today's housing market, 4.1% appreciation. 2019, housing market is going to shift in a bad way for buyers, shift in a bad way if you didn't buy, up 4%. And 2019, next year will be hard on the housing market, especially in these big cities, 11% appreciation. And then finally, July 2021, the housing boom is over as new home sales fall to a pandemic low. Well, we've only seen about 20% appreciation since then. So what's the real?
And just a reminder that new home sales are 10% of the market. 90% is existing home. So again, watch the words in the headlines. We cannot say that enough.
Well, here's the other thing. There's a difference between housing the economic driver and housing the investment, right? So there's no question that sales are slower, right? There's no question about that. You see, although we did just see new home sales surprise to the upside last month by about 13 or 14%. And we just saw existing home sales which is a bigger report, like you mentioned. They were expecting it to decline 4%, and it just went up 0.7%. So a big upside surprise. But still, sales numbers are down. I mean, existing home sales are down 13.7% year over year, which I think can be expected because, listen, we see very little inventory, higher home prices, higher rates. So I still think the purchase market, considering these things, is hanging in there quite well. But back to my point, from an economic driver standpoint, yes, it is certainly much lower as far as home sales. But from the investment standpoint, what always determines price in an investment, right? It's supply and demand. So what I want to do is break down the supply and demand and compare it to when we did have a housing bubble. So if you go back to 2007, if you want to see what a bubble looks like, take a look at this chart. There was 3.81 million homes for sale. There was a glut of supply out there, in addition to some of the things that we talked about, some of the bad transactions being done. Today, the latest numbers, 1.16 million homes for sale. So, 2.65 million less homes for sale today than in 2007. Very different. When we look at the real story on inventory, this is something I found very interesting. When you look at these existing home sales reports and they give you these inventory numbers like 1.16 million, what I didn't realize until not too long ago is actually that they are including homes under contract, which are really off market, right? I mean, if they're under contract, I wouldn't really consider that available inventory. But if you look at the active listings, which is your actual inventory, it's much less than that. It's actually 516,000.
Well, the whole country.
Yes. And the other thing that I thought was interesting was vacancy rates too. So, listen, if you are buying a new home and you're trying to sell your existing home, you have a period there where you're going to be carrying that home, right? And, what is going to happen if there's high vacancy rates? There's a high probability that you're going to maybe do some price reductions. We're not seeing that. In 2007, you saw 3% and change vacancy rates. Today, you have a record low at 0.8%. And then just some other stuff out there, right? I mean, people talk about less demand, and there certainly is less demand, and higher home prices and higher rates are contributing. But the last report we got, average days on market actually went from 17 days, which is blistering hot, to 16 days. And if you look at Redfin as well as CoreLogic, there's still about 60 to 70% of homes that are selling above asking price with multiple offers. Now, is there less multiple offers? Yes. Maybe you're not getting 40 offers and you're getting a handful, but in most of the markets out there, you're still seeing competitive markets. Now, how about the demand side of things? Well, from a demographic standpoint, from people born 33 years ago, if you look at birth rates, we're certainly seeing some favorable demographics where much more people this year than last year and the year before are going to be potentially coming of age to buy a home. But how about the absolute number of households? Well, in 2007, there was 116 million. Today, there's about 130 million. So let's put these things together. 14 million more households, 2.65 million fewer homes. Well, it kind of makes sense why we've seen some really hot appreciation numbers. Now, do I think that's going to continue? No, I don't. I think it's going to moderate. But here's what I want you to think about. First of all, there's three options that you have. Number one, you can buy a home. Number two, you can rent. Or number three, you can be like Will Ferrell and Step Brothers and be living at your parents' house till you're 40, right? So it's not like a stock. And I see a lot of economists make this mistake where they try to compare housing to like the stock market. I can go sell my shares of Apple right now and I'll be okay, right? But if I sell my home, I need to live somewhere else. And those are your three options. So one of the reasons why I think housing is going to continue to be strong is because renting is not a better option. Now, new rents are up double digits. They're almost keeping pace with home price appreciation. But remember, rents can continue to go up. Renewals on average are going up 8% a year. And I think we'll continue to see pricing pressures on rentals. Of course, you don't get the benefit of amortization. You don't get the benefit of appreciation. And your mortgage payment is largely fixed besides maybe, some insurance as well as taxes. But the majority of it is fixed as long as you have a fixed rate mortgage. So my opinion is that I think we will see much slower levels of appreciation, right? So not 20%, and I don't want to continue to see 20%, but do I think we can see mid-single digit appreciation? I certainly do. And it's really because although there's less demand due to some of the challenges we talked about, there's still much more demand than supply out there. Now, here's the thing you have to keep in mind. Real estate is very regionalized. So I'm talking about across the United States, but are some markets potentially susceptible that have gotten too heated to maybe some pricing pressures? Sure. But as a whole, as a nation, I don't think that we're going to see any housing bubble-like conditions. The explanation I like to give is this, is that listen, we were going 100 miles an hour down the highway. Maybe now we're going to be slowing to like 25 miles an hour, but I don't think we're going to be putting the car in reverse. So I anticipate these appreciation numbers to slow significantly. And you'll see people out there make mistakes about this. They'll say, oh, appreciation went from 20% to 5%. That means home prices are going down. No, 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 it doesn't. It means that the pace of appreciation is slowing, but it's still going in the right direction. Now, all markets aren't going to perform the same. Just like if we were talking about stocks for a second and we were in a big bull market, if you look at all the stocks in the S&P, not every single one of them is going to be green, right? You're going to have some that underperform and some that outperform. Same is going to be true here. But all in all, I still think the housing market is your best bet there. I mean, unless you have a really good relationship with your family and you want to live home. And I think that it still presents a opportunity for wealth creation. And just to give you an example, and I think it's important to explain this to customers because people don't know how to quantify this stuff. And listen, 20% appreciation is wonderful, but 5% appreciation, 4% appreciation is fantastic for wealth creation. Here's an example. You bought a $500,000 home. You put 10% down. So your investment is $50,000. Either way, you got to pay to live somewhere, right? But your investment, your initial investment is $50,000. If we saw just 4% appreciation, you'd gain $20,000. Now here's the concept of leverage. Unlike a stock where you have to put all your money in there, right? Unless you're doing derivatives and such, that $20,000 profit on your initial investment is a 40% return. And that's the beauty of leverage in the housing market, right? So I hope that was helpful, team, in helping to kind of break down some of the dynamics that I'm seeing out there. And, and those of you guys that aren't with MBS Highway, if you want to give us a try, email my assistant here, Christine at MBS Highway. We got some special, kind of pricing for you if you wanted to learn more and get information like this every single day, because that's what we do.
Yeah, no, it's great information. Thank you so much, Dan. It is, these are really, it's so important for us to keep on top of this and know how to explain things properly to our clients. Before we take a dive into the rest of this, I just want to take a moment and give you a heads up on our upcoming speakers. So July 5th, we'll have Kevin Peranio with PRMG.
KP, love him.
KP. On the 12th, we will have Dave Luna with Mortgage Educators. On the 19th, we will have my little Megan Anderson with MBS Highway. On the 26th, we'll have Dr. Elliot Eisenberg, our favorite economist. On the 2nd of August, we'll have Bill Lohman. He is a crowd favorite. Rob Crispin will join us on August 9th. Josh Pitts will join us on the 16th. Erin D, who is new to our lineup, COO with Lone People, she will join us on the 23rd of August. And then Mark McArdle will join us on August 30th, and he is with the CFPB. And we are going to be able to pick his brain and ask all sorts of interesting questions. So get them ready, folks. I'm really excited about the upcoming couple of months and what we've got planned. And we have some new things we're going to be rolling out in upcoming weeks. So just stay posted. Our communication is going to get better, I swear. So anyway, okay, so moving right along, I just want to take apart GDP for a minute, Dan, because here's the thing. So we had first quarter GDP that was negative. We have second quarter that's going to be wrapping up in the next few days, right? So when will we get second quarter GDP numbers?
This is the interesting thing about GDP, right? So you don't technically know you're in a recession until about 6 months after officially, right? Because Q1 closes out at the end of March, and then you don't get the first reading on it, which is called the advanced reading, right, until April. And then you get the preliminary reading, which is the second reading in May. And then you get the final reading, which, by the way, I think we're going to be getting tomorrow or so for Q1, the final reading. You don't get that till June. So 3 months after Q1, you know exactly where you stood in Q1. And then you start getting the reports for Q2 after that. And there's 3 months of that. So, one of the definitions out there is 2 consecutive quarters of negative GDP while you're in a recession. But, it's always, and listen, that's not the only definition out there now, right? The person that calls this is the NBER. They've now expanded their definitions, but
please hold who?
The NBER.
What is
National
that?
Bureau of Economic Research. They're the ones that really officially call the recession. But people can speculate if we're in a recession right now. If you look at Kathy Wood from ARK Invest, she certainly thinks so, right? But but they call it in the past, so you don't technically know.
Gotcha. Yeah, exactly. And then what was interesting is because again, we've always heard this, oh, 2 consecutive quarters. And then when first quarter GDP came out and it was negative, people were really just saying, just ignore it. There were, like the 3 components within the GDP number weren't jiving or weren't, bad enough for them to think we were in a recession. So it'll be really interesting to see what we get tomorrow and then how it plays out with second quarter, right?
Well, on that note, right? I mean, I was one of the ones out there saying that Q4 GDP, which was very strong, I was saying, don't believe that it's as strong as it looks, because a big thing that can go into the GDP numbers is inventory build, right? So Q4, we know that there were supply chain issues. We know that we had holidays. So companies were really stacking up on their inventory. And that made Q4 GDP look so much stronger. Some people were arguing that, oh, well, they had inventory, so that's why Q1 is negative, right? I don't necessarily buy that. And if you look to Q2, you can't make that excuse anymore. And they're expecting a goose egg, right? So listen, I don't necessarily know if we're in a recession right now, but I think as the economy continues to slow, as if they continues to tighten, that's why my belief is really more of my chips are in that by Q1 of 2023, we will be in a recession.
Okay. Or at least we're going to know we're in a recession. Is that, or are we going to know 6 months after Q?
I think we'll be in like recession-like conditions in it's always hard to pinpoint these things.
I know we're not going to.
But Q1 2023, I think we'll be in recession-like conditions. Whether or not that gets called several months later, it's another thing.
Right. It's like pinning Jello to a wall, as far as I'm concerned. So, okay. So, what?
You need a big pen, and then it doesn't work. Never mind.
Oh, pin. Got it. I'm like, what?
But a recession. Listen, recession is not ever like a great thing, right? I mean, I don't want to sound insensitive here.
Right.
People lose their jobs, and usually the risk on assets like the stock market and stuff. You usually see that go down substantially. We've already seen bear market conditions for the Dow, S&P, and the Nasdaq. They've had a little bit of a rebound, but you could see some significant further declines if we actually get into a recession. But on the silver lining end of that, you typically always see interest rates decline. You see a good refinance opportunity, right? So all of the loans that you're doing today, those could be the refinance opportunities that you're going to have, end of the year next year. And housing typically performs pretty well as well.
Right. I think that's one thing we can all take comfort in is the historical performance of housing during a recession, where values will probably continue to be stable. I'm very curious. I'm watching all of this. NAR a few weeks ago suggested that they thought that appreciation would go from 20 to 30% to a lovely 5%, like we were talking about. And but I'm so interested as I'm watching like the sales prices and then the price reductions and realtors have to start doing their jobs again. Like, what do you want to list it for? What is it actually worth? Do you have any idea? Because now you got to learn how to do that, right?
It's another thing too. You don't want to, market value is one thing, and then you could have some markets where things are getting listed crazy, and then you're seeing some price reductions back to reality, but it's not necessarily pricing declines, right? So those are two different things, but you're right. I mean, listen, I think that they're going to have to start doing their jobs a little bit more.
I ran into this last week where client came in and then they discovered they went into contract and discovered it needed a new roof that hadn't been disclosed, and so they went and negotiated it, but they put it as an addendum where we have this much work, we want a credit for this much work, blah blah blah. And I'm like, you can't do that. We're gonna have to do an inspection, show the work is done. And I'm like trying to explain, I go, you obviously have a brand new realtor who's only been in this good market and has not been in a real market. They would not have made this rookie mistake.
That realtor had never heard of a PIW. So do the math on that one, right?
Yeah. You do bring up something interesting though, people giving up, a lot of things that they didn't used to, as far as, waiving the inspection, waiving the, appraisal, which is a little bit scary in my opinion,
It's coming back, baby. Those inspections are coming back. The other thing I've seen in the last week a couple of times is advertisements where realtors and sellers are offering large amounts of money to pay points to buy down rates to get people comfortable with what they're getting as an interest rate. So I thought that was really something. Hadn't seen that.
The buy downs are coming back too.
I know. I haven't seen them though.
Well, I still think, I think that they would be a little bit more in vogue if we saw demand come down further, right? But seller concessions of buy downs to make it a little bit easier for people. I do, I speak to mortgage professionals every day, and from a couple different companies, I've had some people tell me that they're starting to market that and utilize that if available.
Yeah, exactly.
I have this,
See,
I found it very easy to get a seller to pay points to buy down a rate, even in the hottest market, because all you're doing is saying, all we're going to do is increase the purchase price a little bit and then give them a credit. There's no consequences to the seller to do this.
I think easy's a slight exaggeration
Hmm.
in the previous market that we were just coming out of, but I get your point.
So one question I'm seeing here in the chat is someone's asking for my prediction on the stock market. So I certainly think that, I've been kind of talking about this for a while, where I thought that, the stock market would be in for some pain and some tough times because the Fed was tightening, because I thought that there'd be a recession. And historically, you see, like, on average, a 35% decline in the stock market, right? If we're looking at, let's say, the S&P. At its low, and it came back from there. I think it was down a couple of weeks back or so, around 24%. But I think you have some more pain in store there, unfortunately. Doesn't mean that there's not a lot of opportunity to, maybe at some of those lower levels, start dollar cost averaging in. Another thing that I do, for those of you not aware, is I have a crypto company. So I've created almost like a MBS Highway, but for the crypto markets. And, we've seen the cryptocurrency markets, which is really behaving kind of like a risk on asset currently, because of some of the participants in there really take it on the chin, right? So come down even much more so than stocks have, but there's been a high correlation between the two. But I really think that there's a really big opportunity there, not for, let's say, you have to be in it for a little bit, but I think where people are going to look back and see Bitcoin at 20,000 and say, man, I wish I could have got in at that, because it really is something that I think is revolutionary. And I think the big thing there, besides the blockchain, is, we finally have like a true, scarce, and decentralized asset. And I really think that it's going to be a building block for something much bigger. And I think it's going to change the world and a lot of the things that we do out there. So
I was going to ask you about crypto, because I know you're really into it. So you think it's coming back?
Oh, eventually, yes. I mean, I don't think crypto is dead by any means.
And if
By the way,
if people want to check into your crypto, what do you call it? Is it a show? Is it a system?
It's called Crypto Charged. It's called Crypto Charged. You can
Okay.
sign up for like 2 weeks for free to check it out if you'd like. But we do daily videos breaking down the markets. We look at the charts, do technical analysis. Something that's unique to crypto is we're able to look at what's called on-chain analytics, because everything is happening on a transparent blockchain. So you can get a lot of really interesting investor sentiment and insights through that. So we kind of make it easy to understand, and in a world that I don't think there's a lot of good explanation out there. So try to take something complicated, make it easy to understand, break down different projects. But it's a fascinating space. And, specifically the blockchain, I think people are going to be surprised how much that changes the things that we're doing every day. Meaning, instead of things going to a centralized verification type process, it's going to be done on this distributed global ledger type blockchain. So like the thing with this is this is what I find interesting, and this is the simplest reason why I think Bitcoin is going to do really well, right? So what's the biggest problem we're facing right now? 8.6% inflation. Why? Well, you have these central institutions like the Federal Reserve that has a lot of power over monetary policy, the supply of money out there, the cost of money out there, and they don't always make the best decisions. Well, you also have these intermediaries like banks who really need to facilitate the flow of funds. But if you think about how a bank works and how things work in our centralized finance system, well, they have their own ledger, right? So if I have an account for Dan Habib, my direct deposit comes in, I swipe my debit card, it makes sure that, I have the funds I say I do, and it keeps like a live running tally. But essentially, all this is happening behind their security wall, and they're controlling the ledger, right? But the whole thing is they want to make sure, since most of the money's digital nowadays, that you can't double spend the dollars that you say you have, right? So I can't go swipe my debit card 4 times real quick. Well, Bitcoin essentially is the first and only really coin that is truly decentralized, and the use of the Bitcoin blockchain, where instead of having a centralized ledger, you have a distributed ledger that's transparent, right? You're still kept, your information is still kept private through the use of public and private keys. But now you have millions of computers on the network that are verifying the transactions. Now you might say, well, I've heard there's a lot of energy and, cost to doing this, right? Well, why would you want to do it? Well, the incentive's in the right place, meaning the reward for keeping the network secure and verifying transactions right now is 6.25 Bitcoin, right? So at that current pace and at the basically protocol and how it works, about 900 Bitcoin per day are mined, right? So the only way you get new Bitcoin into circulation is not from the Fed creating dollars and stuff like that digitally today. It is from keeping the network secure, and it's a byproduct of that. And the miners out there, the people that are keeping the ledger secure and accurate, they receive a reward of 6.25 Bitcoin currently, as well as any fees tied to the transactions. But every 4 years, so come the year 2024, that reward gets cut in half. So instead of having an inflation problem, you actually see inflation going down and going down significantly over time. Here's the other key aspect. There's only 21 million Bitcoin that can ever be mined. And so far, over 90% of those coins have been mined. So by the year 2150, the last Bitcoin ever will be mined. It is literally the hardest and scarcest asset that we've ever seen. It can't be changed. It can't be altered. Transactions on the blockchain are what's called immutable. You can't have a Fed that says, hey, you're too big to fail and erase the debts that somebody owes. So it's very different. But in simple terms, supply is going like this and adoption is going up like this at a faster pace in the internet, likely because it has the rails of the internet to create adoption, right? But there's also like much bigger picture stuff out there too. We have a lot of people in this world, 2 billion of which don't have infrastructure. They're not lucky like us, right? So they don't have a bank, they don't have a net worth, they don't have an identity. Well, what do they need? Well, you have Elon Musk with Starlink shooting his satellites into orbit. He's planning on having global Wi-Fi. And then if you think about Moore's law and how cheap it is for a cell phone from a cell phone company, you think if they have internet, they're not going to give people free cell phones. Now that individual, through the use of the blockchain and having internet and a cell phone, they can have a net worth, they can interact in the global economy. So just like some really big picture stuff out there to think about too. So anyway, you can see I'm passionate about that as well.
Yeah. Okay. So I am fascinated by this because I understand it. So I have such a tiny piece of information out of this monster bucket full of it. So again, tell people where they can sign up to follow you on that.
So just go to cryptocharged.com and you
with a D on the end.
Yeah, I'll put it in here.
Great. Perfect. Yeah.
And what year they're going to stop making Bitcoin or mining it?
Say that one more time.
What year did you say they would stop mining Bitcoin?
Oh, so it's not that they're going to stop mining it. It's that the last one will be mined, meaning like they're still going to have the need for the network and verifying the transactions. But at that point, instead of getting the mining reward, you're going to be just getting the fees tied to the transactions. But the last Bitcoin ever mined, based on mathematics, is estimated to be around the year like 2150. But, that's because, you keep having and having and having and having. But remember, at this point in time, over 90% of the supply that's ever going to be in supply has already been done. So
okay, but who makes up those rules? Okay, that's a whole nother conversation. Don't answer that question. We don't have.
We can have a follow-up if you want to go real deep.
Yeah, we can. We could do that. I have this idea for Thursdays. We might do that on a Thursday.
You got it.
So quickly, I wanted to mention. So here's the announcement. Ready? Equifax, Experian, and TransUnion, our three best friends, have announced that effective July 1st, 2022, they will no longer include medical debt that was paid after it was sent to collections on consumer credit reports. Kids, that's a big deal. I'm excited.
Huge.
In addition, the time period before unpaid medical collection debt appears on a credit report will be increased from 6 months to 1 year. Also, very good news. The companies also announced that in 2023, they will only report medical debt in the amount if the amount owed is at least $500. So take note of some of this. I might bring it up again as we go forward, just to remind you. They think it's going to remove about 70% of medical debt from consumer credit reports. Just FYI, in my conversation with my buddy, my new best friend at the CFPB, they are all over this medical debt on credit reports as well. So just know that it is happening as we speak. July 1st is in 2 seconds. And so if you have clients who have had issues with medical debt on their credit reports, you've got some relief coming. Whew, thank God for that, right? So I think that as we go forward, we have a little saying around here because the market has been so volatile. If you see a rate you like, lock it in. So we are going to stay with that, right? Because it is going to continue to be like, whew, right? I mean, you're expecting more volatility as we go forward.
For sure, expect more volatility. Interestingly, though, if you look from when the Fed hiked, well, it's not going to be a straight line. When since they've hiked 75 basis points, we've seen the 10-year come down from about almost 350 to now 319. We've seen a little bit of a nice increase in mortgage-backed security pricing. So it's not going to happen right away, but I do think by Q4 we'll start to see a little relief in inflation and maybe a little relief in mortgage rates.
I think it's for me, the volatility is the hard part, right? I mean, if we're at 6%, stayed at 6%, everyone kind of gets accustomed to it. It becomes the new normal, then it's fine. It's this woo, woo, woo. And then you've got this whole group of kids or people who've decided that 2.5% is their birthright. And how dare the rates be 6%? And what are we thinking?
Well, I like explaining it like this, right? It's like, so listen, you can't have yesterday's rate. You have
right.
You have two decisions. You can have today's rate or you can have tomorrow's rate, right? And as long as you explain to them where you think tomorrow's rate is going to be and why it's a good idea to lock in now, and also that you're probably going to have an opportunity to save them some money and refinance them over the next 12 months, then I think that's the best you can do there.
Absolutely. And don't promise them the world. That's the other thing. I've talked a lot in the last few months about we need to refocus on payments and not rate. People get so wrapped up in their rate and they don't make a rate, they make a payment. So you focus on what is your payment every month and can you afford it? And that should drive whether you're going to do a transaction or not, right? And also make sure you're looking at the whole picture. And I know you have a tool for this on MBS Highway. Not that I've ever logged in to look at it, but I keep swearing I'm going to, that you can take, if somebody has $220,000 in student loan debt or an RV that's $8 billion and has some crazy interest rate or whatever, you can go in, do the math, make sure you're being a real asset as far as guiding your clients. Be an advisor. Don't be a salesperson. Doggone it. Right?
Love it.
There was another, and again, mortgage delinquencies continue to be really good. We're having massive layoffs in the mortgage space. And just keep an eye out, be kind to everyone. I mean, this is not the group who would be, cheering because someone else isn't doing well, but if you see opportunities where people can get jobs, make sure that you are helping people find where they can go to work. If, good people, we need to keep good people in the business, right? So I saw, and I don't know if you know about this, but so if you don't, you can just tell me to move on. But there was a headline, PIMCO gets picky on non-QM yields. So Pacific Investment Management companies, they have been behind a lot of non-QM loans for years. But they are also part of, anyway, they are getting pickier. They want yields at 8% on their non-QM loans. And where in June, I think it was like 6.5, or I guess we're still in June, but earlier it was like 6.5%. So, it looks like we're going to see an increase in the non-QM rates too, even though you can get a hard money loan for 8% right now. So make sure you're looking at everything. What?
Yeah. Why go non-QM if you just do hard money?
Yeah, make sure you're looking at all the options, guys. We keep pounding that beat and it is noon. We just burned through an hour. Holy guacamole. So
wow.
Best hour.
Crazy. All right. So next Tuesday, Kevin will be in England. I will hopefully be back from Mexico, God willing. And we will have Kevin Peranio on. He's always very entertaining and full of lots of information. Dan Habib, you are wonderful. Thank you so much for joining us. We'll look forward to having you back again soon. And I hope people, find you for your crypto information. So there you go, guys. Have a wonderful rest of your week. Happy 4th of July. See you next Tuesday. Bye.
Bye, everybody.
Take care. Thanks, Dan.
Thank you, Dan.